Imagine running the company that protects insurance companies. When hurricanes destroy cities, when earthquakes level entire regions, when airlines crash, or massive industrial disasters occur, someone ultimately absorbs part of those losses. That company is called a reinsurer. And for more than 160 years, Swiss Re stood among the most trusted in the world. Unlike ordinary insurance companies, Swiss Re rarely sold policies directly to individuals. Instead, it insured the insurers. A car insurer might fear one catastrophic year. A health insurer might fear an unexpected pandemic. A property insurer might fear an earthquake destroying an entire city. Rather than carrying every risk themselves, they transferred part of that risk to Swiss Re. In exchange, Swiss Re collected premiums from insurance companies around the world. Its business depended on one principle. Thousands of unrelated risks, spread across hundreds of countries, would rarely fail all at once. Some years hurricanes would be expensive, other years earthquakes, other years aviation accidents. But across the entire portfolio, profits remained remarkably stable. That made Swiss Re one of the safest businesses in global finance. Until management decided that understanding risk also meant it could take more risk. By the early 2000s, financial markets were booming. Banks were creating increasingly sophisticated securities. Mortgage lending expanded rapidly. Investors searched desperately for higher returns. Traditional reinsurance produced steady profits, but steady wasn't enough anymore. Management wanted stronger growth, higher returns, and a larger role inside global financial markets. Instead of only protecting insurance companies, Swiss Re gradually began protecting banks, not by making loans, but by insuring the financial products those banks were creating. The company believed risk was simply another probability problem, one that mathematics, models, and diversification could solve. It would prove to be one of the most expensive assumptions in modern financial history. To understand how Swiss Re became exposed to the financial crisis, you first need to understand what changed inside its business. Traditional reinsurance begins with a real-world risk. A hurricane may hit Florida. An earthquake may strike Japan. A factory may burn down. The timing is uncertain, but the event itself is understandable. Swiss Re could study decades of historical data, estimate the probability, charge a premium, and spread the risk across thousands of unrelated policies. Financial risk looked similar, but it behaved very differently. During the housing boom, banks issued enormous numbers of mortgages. Those mortgages were bundled together, turned into securities, and sold to investors. The securities were then divided into layers. The safest layer received payment first. The riskiest layer absorbed losses first. On paper, the structure appeared diversified. Thousands of borrowers, different cities, different properties, different income levels. Swiss Re believed many of these securities were unlikely to suffer catastrophic losses at the same time, so it began providing protection against them. Imagine an investment bank holds a portfolio of mortgage securities worth billions of dollars. It worries that if borrowers default, the portfolio may lose value. Swiss Re enters the transaction and agrees. If losses exceed an agreed level, Swiss Re will compensate the bank. In return, Swiss Re receives a fee. That fee looks similar to an insurance premium, but the risk is not the same. A hurricane destroys one region. A nationwide housing collapse affects millions of borrowers simultaneously. Mortgage defaults are connected. Falling property prices weaken collateral. Unemployment increases missed payments. Banks sell assets. Prices fall further. One problem reinforces the next. The risks that appeared diversified were all connected to the same economic system. This was the first major weakness. Swiss Re applied insurance logic to financial assets whose losses could become highly correlated during a crisis. The second weakness was scale. These contracts could protect portfolios worth billions of dollars. Swiss Re received relatively small annual fees in exchange for accepting potentially enormous future obligations. During normal years, the strategy generated attractive profits. Because losses remained low, the fees appeared almost effortless. That success encouraged the company to write more protection. More transactions, larger portfolios, greater exposure. What appeared to be diversification was slowly becoming one concentrated bet that the global housing and credit system would not fail all at once.
For several years, the strategy appeared remarkably successful. Housing prices kept rising, mortgage defaults remained low, banks continued creating new securities. Swiss Re collected millions in fees while paying very few claims. Every successful year reinforced management's confidence. The models appeared accurate, the diversification appeared real, the risks appeared controlled. But hidden inside those models was one assumption that would eventually fail: that housing markets in different regions would not collapse together. Historically, that seemed reasonable. A downturn in California didn't necessarily mean a downturn in Florida. Problems in one city rarely spread across an entire country. The mathematical models were built on that history. But something had fundamentally changed. Mortgage lending standards had weakened dramatically. Banks increasingly approved loans to borrowers with poor credit histories. Many borrowers purchased homes with minimal deposits. Some loans required little verification of income. Others offered extremely low introductory interest rates that later increased sharply. As long as property prices continued rising, these weaknesses remained hidden. If borrowers struggled, they simply refinanced or sold the property at a higher price. The system depended on one condition: house prices could not fall nationally. By 2006, that assumption began breaking. Housing prices stopped rising, then they slowly declined. Borrowers who had expected easy refinancing found lenders becoming far more cautious. Some homeowners now owed more than their homes were worth. Instead of selling, many simply stopped making payments. Defaults increased. Normally, that might have remained manageable, but this wasn't an ordinary mortgage market anymore. The same underlying housing market supported thousands of structured securities owned by banks, investment funds, pension funds, and protected by companies like Swiss Re. As defaults spread, losses began appearing everywhere simultaneously. The diversification had been an illusion. Thousands of different securities were all connected to the same collapsing housing market. Swiss Re wasn't facing one insurance claim. It was facing an entire financial system, making claims at the same time.
By 2007, the losses were no longer theoretical. Mortgage defaults accelerated. Investment banks began reporting billions of dollars in write-downs. The securities Swiss Re had agreed to protect were rapidly losing value. This is where the business model changed completely. Swiss Re hadn't purchased the mortgage securities itself. Many people assume it lost money because it owned toxic assets. That wasn't the primary problem. It had insured them. Imagine a bank owns a portfolio of mortgage securities worth $10 billion. Swiss Re agrees that if losses exceed an agreed threshold, it will compensate the bank. For years, nothing happens. Swiss Re simply collects premiums. Then, Housing prices collapse. Mortgage defaults spread. The value of the securities falls dramatically. The bank now turns to Swiss Re and says, "Our losses have exceeded the agreed limit. It's time for you to pay." One claim becomes 10, 10 becomes 50, 50 becomes hundreds of separate contracts, all triggered by the same collapsing housing market. Swiss Re suddenly discovered something devastating. It hadn't diversified away the risk. It had concentrated it. Thousands of contracts signed with different banks were all linked to one underlying event, the collapse of global housing credit. As losses spread, another problem emerged. These contracts weren't ordinary insurance policies. Many had to be marked to market. That meant Swiss Re couldn't simply wait to see the final losses years later. As market values deteriorated, it immediately had to recognize enormous losses on its balance sheet. Even before all the cash payments were made, the accounting losses arrived. Investors watched billions disappear. Confidence deteriorated rapidly. Analysts questioned whether the company's models had fundamentally misunderstood financial risk. The company that had spent more than a century helping insurers survive catastrophes was now discovering that a financial catastrophe behaved nothing like a natural one. Nature destroys regions. Financial crises destroy confidence. And once confidence disappears, losses spread much faster than any hurricane or earthquake ever could. By 2008, Swiss Re faced a crisis unlike anything in its history. The company still possessed enormous financial strength. It still had one of the world's strongest reinsurance franchises. Its traditional insurance business remained profitable. But confidence had become the new battleground. This is another important distinction. Swiss Re wasn't collapsing because it couldn't pay every claim immediately. It was collapsing because financial markets no longer knew how large the final losses might become. Uncertainty became more dangerous than the losses themselves. Every quarter, new write-downs appeared. Every revision changed investor expectations. Every unexpected loss reduced confidence further. That uncertainty affected something every reinsurer depends upon: capital. Insurance companies promise to pay future claims. To make that promise credible, they must maintain enormous capital reserves. Clients choose reinsurers not simply because of price, but because they believe those companies will still exist decades into the future. As Swiss Re's capital declined, rating agencies became increasingly concerned. A lower credit rating meant customers might move business elsewhere. Less business meant lower future premiums. Lower premiums meant less future profit. The crisis was beginning to threaten not only current losses, but the long-term franchise itself. Management understood they needed more than accounting profits. They needed fresh capital, quickly. In early 2008, Swiss Re secured a major capital investment from Berkshire Hathaway. Warren Buffett agreed to invest approximately $3 billion CHF. Notice why this mattered. The money didn't erase the mortgage losses. It restored confidence. Investors now believed Swiss Re had sufficient capital to absorb future claims. Clients regained confidence that the company would continue honoring its obligations. The investment bought something even more valuable than cash: time. Time to reduce exposure. Time to strengthen the balance sheet. Time to return the company to its traditional business. Swiss Re survived not because the losses disappeared, but because confidence returned before confidence itself became the next catastrophe. The crisis forced Swiss Re to ask a difficult question. Had it misunderstood risk or simply misunderstood correlation? For more than a century, the company had mastered insurance. It understood hurricanes, earthquakes, floods, industrial disasters. These catastrophes were largely independent. One earthquake in Japan didn't automatically create another in California. Diversification genuinely reduced risk. Financial markets behaved differently. During normal conditions, mortgage defaults appeared independent. One homeowner losing a job didn't affect another family hundreds of kilometers away. But during a systemic financial crisis, the assumptions changed completely. Falling property prices reduced household wealth. Banks tightened lending. Businesses cut investment. Unemployment increased. Consumer spending slowed. Mortgage defaults accelerated. Every problem strengthened the next. The financial system became one enormous feedback loop. Swiss Re realized it hadn't insured thousands of separate risks. It had insured one giant interconnected system. The company's mathematical models had measured individual probabilities extremely well. What they underestimated was what happened when the entire system failed together. This fundamentally changed Swiss Re's strategy. Management rapidly reduced structured credit exposure. Capital allocation shifted back toward traditional reinsurance. Risk models were redesigned. Greater emphasis was placed on stress testing, extreme correlation, and systemic scenarios. The lesson extended far beyond Swiss Re. Banks, insurers, asset managers, rating agencies, and regulators all reached the same conclusion. Historical data alone cannot predict unprecedented financial behavior. The greatest risks often emerge not because individual assets fail, but because relationships between those assets suddenly change. Swiss Re survived because it learned that lesson before it was too late. Many others did not. Swiss Re never became another Lehman Brothers. It never required a government bailout. It never disappeared. But the crisis permanently changed one of the world's oldest reinsurers. The company survived because its traditional business remained fundamentally strong. Insurance companies still needed protection against hurricanes, earthquakes, floods, industrial disasters. Those risks hadn't disappeared. Only one part of Swiss Re's strategy had failed: the attempt to apply insurance mathematics to an interconnected financial system. That distinction matters. Swiss Re didn't lose money because financial innovation was inherently bad. It lost money because diversification has limits. When every asset depends on the same economic engine, they stop being diversified. They become one concentrated risk. Today, Swiss Re remains one of the world's leading reinsurers. Its capital position is significantly stronger. Its exposure to structured credit is dramatically smaller. Its risk models place far greater emphasis on systemic stress, liquidity, counterparty risk, and extreme correlation. The company emerged wiser, not because it predicted the crisis, but because it survived long enough to learn from it. The lessons extended far beyond Swiss Re. Modern banking regulation, insurance supervision, capital requirements, and enterprise risk management were all reshaped by one central realization. Financial systems behave differently from natural systems. Nature creates independent catastrophes. Financial markets create connected catastrophes. And connected catastrophes grow exponentially. Swiss Re entered the crisis believing it was insuring individual financial risks. It left understanding it had been insuring an entire financial ecosystem. That realization changed the company forever. In the end, Swiss Re wasn't nearly destroyed by hurricanes, earthquakes, or floods. It was nearly destroyed by underestimating how quickly confidence and correlation can spread through global finance. Sometimes, the greatest catastrophe isn't a natural disaster. It's believing that independent risks will always remain independent.